Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and Senthil Manikandan of Newberry Capital and Avinash of Joindre Capital joins us on the show. Thank you so much for both joining me on the show. Today on Hot Money, we'll discuss stocks like ACC, United Spirits, the two-wheeler stocks, and we also ask our guests for one of the top picks for an investment perspective. Let's start with the first one, and that is ACC. ACC came out with numbers, did manage to surprise the street, but what it's done, it's up 12%. It's taken the entire cement up with pack up with him. So you have your counters like an Ambuja or a Dalmia Bharat, or even counters like Ultratech or an India Cement. All these counters are doing extremely well in trade. So what's the move ahead for ACC? ACC, remember, is one of the cheapest stocks in the cement place at this point of time. But is there more traction for the counter going ahead? It's been a marked underperformer. It's down 15% on a 12-month basis. This is after excluding a 12% move that we saw in trade today. So what's the view for ACC going ahead? Avinash, your opening statement on ACC, what did you make of the numbers?
No, I think numbers definitely were quite surprising, especially on the realization front. I think clearly margins were under pressure, so this was in line with what the street and our expectations. I think overall the street is now expecting that going forward, what's the status on the merger with Ambuja, and most importantly going forward, how would the coming quarters pan out. But overall, I think a pretty decent set of numbers. If you see the operating EBITDA and the top line growth, although the bottom line was more or less flattish.
Okay, so that's the view that's coming in on ACC at this point of time. We'll discuss more on ACC at this after Senthil gives his opening statement. What did you make of the numbers, Senthil?
So the Q1 volume numbers are pretty much in line, like 7 to 8% volume growth was we are also expecting from the company. So the 7% volume growth was almost in line. But if you compare ACC with the other big players like Ultratech or Shah Cement, there has always been the major factor is cost factor, because ACC is operating its plants which are much older compared to the Ultratech or Shah Cement. Their operating margins tend to be lower than these players. If you look at the EBITDA per ton, it used to be around 15 to 20% lesser than the Ultratech or Shah. And another major factor is on the growth. If you look at 6-7 years back, ACC used to do around 22 million tons of production, and if you look at the same for Shah Cement used to be a 9.5 million production. Now if you look, Shah Cement has outperformed ACC in terms of volume and production. So last 6 to 7 years there has been no growth in the volume, tepid growth in the capacity expansion. These are the negative factors with respect to ACC is concerned. On the positive.
Okay, so that's the view that's coming in. We'll discuss ACC's results in detail. What are the positives that you made of the results you were saying?
So positive with respect to business itself is concerned, they are a pan-India player. So they are not prone to any regional issues related to any sand mining that we saw last year with respect to Tamil Nadu is concerned. But on the other hand, if you see the strong cash flow generation, last year they generated cash flow of around 1,000 crores, dividend payout of 50%, plus cash of around 7 to 800 crores on the balance sheet. So these are the positive factors along with a strong band. But the market expected the merger with ACC and Ambuja, but that didn't go. That was one of the negative factors. So apart from that, I think we remain neutral on the company, basically because of the valuations.
Valuations, do you find it on the higher side for ACC because it's trading cheaper than most of the other cement stocks?
Yes, sir. Actually, we are on the valuations is on the lower side, but we don't expect a volume growth what we are expecting versus Ultratech or Shah Cement. So volume growth will tend to lag the industry peers. But as you mentioned, the valuations of, if you look at the market cap is around 20,000 crores. If you take an enterprise value on a EV to EBITDA basis 13-14 times, I think the fair valuation could be anywhere around 30 to 30,000 crores. This is compared to Ultratech or Shah Cement, it is trading at a lower valuation, mainly with respect to no volume growth which you have seen in the last 5 to 6 years.
Okay, and do you think that the move that has happened is solely on account of valuation and not because of the numbers, more say of in terms of that it's cheaper than the others? That's why do you think that the move, this 12-13% move would have come in?
Yes, basically because of the recent correction we saw in the counter, like 10 to 15% downside before the results was declared. Now I think we have to watch out for the merger and how they are going to improve their volume growth going forward, because single digit volume growth is not going to be a major growth driver going forward.
Okay, so that's the view. Avinash, but this is the second cement company to come out with numbers. Ultratech was rather muted.
Yeah.
What did any major difference that ACC sprung a surprise that that you're seeing such a move that's coming on ACC and the cement pack that Ultratech couldn't get through?
No, I think very clearly, if you see the kind of relative valuation, discount which ACC trades vis-a-vis Ultratech, I think clearly ACC has been trading on a lower multiple as compared to Ultratech. I think clearly some sort of catching up has happened, and I think the numbers, at least at the operating level and at the top line level, were pretty decent. I think considering the fact that this was a challenging quarter in terms of the cost factor, although margins were down by about 50 basis points. I think what the market would obviously like to know is now, with the new managing director, clearly how does the merger with Ambuja Cements pan out, and most importantly, if this number from single digit volume growth gets into double digits, they already have a pan India presence, so operating efficiencies, if they do come in, a lot of operating leverage could obviously come in from the capacity. And our sense is that at these levels, despite the fact the stock has moved up by 10-12%, it's got a lot of catching up to do. And obviously, if with the government pre-spending in an election year, hopefully the MSP prices have been risen, so I think you could see a stronger double-digit volume growth maybe in the second half of FY19. So all in all, I think definitely compared to Ultratech, ACC definitely could possibly get further re-rated.
Are you still factoring in the merger, because the management has said that right now that possibility is not happening? They will go in for a different type of agreement. So is the street still factoring in a potential merger?
I would believe, Darshan, because although this has not been factored into our calculations, our sense is the move in the stock price and possibly the kind of upside potential could possibly be looked upon as a combined entity. And I think obviously, at least not in the immediate short term, but in the longer term, I think the merger would definitely stand to benefit the consolidated entity.
Okay, so that's the view that's coming in on ACC at this point of time. The other result that we want to speak about is United Spirits. Started weak, moved to the day's high. It's trading rather flat in today's trade. It's up almost 1% in trade. But the conference call has already started. It will be interesting to see. And United Spirits usually moves in on a very rapid scale only after the conference call and details come out. So we'll try to get in more details from the conference call. But nevertheless, the numbers were rather weak in trade. What is the management saying is up to the conference call. But what should one make on the absolute numbers that have actually been showed up? We'll ask our experts. Senthil, what did you make of the numbers for United Spirits?
So if you look at United Spirits, you have to look at 2 to 3 key metrics. One is on the volume growth of the prestige and above segment. That has came in a tad 2 to 3% below the expectation of 16%. It came in at 13%. On the other hand, if you look at the popular category, degrew by 3 to 4%, but I think that was in line with the expectation. There was a gross margin expansion, mainly due to with the product mix and the price mix. There is a price change also. But on the other hand, they have increased their ad spend by around 30% year over year. So on a percentage to sales, the ad spend has increased by nearly 130 bips. So overall, we are quite positive on the business wise, but we remain quite neutral because on the valuations. If you look at the valuations, it's trading at a EV to EBITDA of around 35 times. So it has already factored in the margin expansion going forward.
Okay, so that's the view that Senthil is giving on United Spirits. Avinash, what did you make of the numbers?
No, I think volume growth was definitely disappointing, Darshan, and I think the markets would obviously look forward to the commentary in the conference call as to how this volume growth could actually get kick-started. Our sense is that unless we see stronger double-digit growth both in the premium and the popular segments, the markets have already given a premium valuation to this company, and our sense is that the business appears good from a 2 to 3 year view, but in the very near term, there don't seem to be any major earnings triggers which could further re-rate the stock. As far as the quarter performance is concerned, I think if you leave alone the volume growth, I think operationally EBITDA was up by about 27-28%. Top line was up by 13%. So the top line growth has not actually come in, largely because the volume growth has lagged behind.
Okay, so that's the view that's coming in. Valuations obviously playing a big role on United Spirits. We'll throw it up open for discussion. Avinash, the conference call is all. Anything that you would be interested in hearing from the management that would help you make your decision with United Spirits going ahead?
No, I think the kind of money they've spent, last quarter, I think the World Cup and the FIFA World Cup happened, so they've spent a lot of money. So possibly going forward in the coming 1 or 2 quarters, what's the ad spend expenditure expected to be, and what's going to be the cost benefit analysis? What kind of volume growth number could we expect? I think at least in the next 1 or 2 quarters, that would be a very key monitorable I would be looking out.
Okay, so that's the monitorable that Avinash is looking at. And Avinash, anything apart from United Spirits that you like in this space? Lots of companies now in the listed space, in the liquor space. Anything that you like?
No, in fact, we had earlier at lower levels looked at Radico Khaitan. Our sense is that Radico Khaitan also has done pretty well. In fact, the fourth quarter numbers were quite strong in terms of both the volume as well as the margin growth. Our sense is that Radico definitely looks well positioned, and our sense is, maybe not at the current levels, but from a slightly lower level, for a medium to long term holding, Radico can be a good buy.
Okay, Radico is something that Avinash likes. What about you? Anything that you like in the alcohol space? You said that valuations probably would deter you from buying it. Would you buy United Spirits at this rate? That's what. Does it look attractive, or do you still feel valuations are very expensive? It's come off because it's come off from the highs we had seen recently.
So in the entire liquor pack, we continue to prefer USL because of being a leadership position they maintain. Because liquor industry is prone to many negative surprises, right from the state taxes to the lot of regulations that the governments come in. Being a largest player, leadership player, this gives them enough leeway to sustain these negative surprises. So this business has to have a capacity to suffer. So I think USL has the kind of brands and the distribution strength there. And if you look at the last 3-4 years, the company has been in works. Like first, there was an internal work of realigning the management, making a professionally run company. And now, if you look at last 1.5 years, there has been a lot of issues. First started with highway ban, next came in GST. So we have to look at a strong business, and USL is definitely a strong business, and they have the capacity to suffer. So in the long term, we continue to prefer USL. Any decline in the counter is ad.
Okay, so that's the view that's coming in on United Spirits. Let's move on to the next one, and that is basically a sector that we want to address. No doubt most of the two-wheelers have bounced back from the lows of the day today, but over the past few days we've seen that most of them are trading at 52-week low. So what's the view ahead for the two-wheeler space in terms of, and the entire thing started with Bajaj Auto coming out with numbers and then indicating that they're going in for market share and not the margins at the higher level. So what's the view? Is it going to get messy for the two-wheeler space? That's what we're going to ask for. Avinash, how should one play the two-wheeler space at this point of time? Most of them have corrected. Have they reached valuations where any one of them looks attractive?
I think clearly, in terms of valuation comfort, I think looking at the kind of management commentary from Bajaj Auto, I think we are going to see a lot of, discounts as well as margin pressure for most of the two-wheeler companies. In fact, interestingly, in Bajaj Auto's annual report for this year, they clearly mentioned that market share gain is going to be their main focus, and pricing obviously is going to be very competitive. So our sense is that, Darshan, if one were to actually get into two-wheelers, I think one would definitely wait for possibly one more quarter and then look at the second half of FY19. But overall, it's going to be a very competitive market, and most of the manufacturers, looking at what Bajaj Auto has done, I think clearly the direct hit would be to Hero MotoCorp, because they control almost 60% in the economy segment. So I think clearly one would like to wait and watch how this strategy pans out. But as of now, I wouldn't like to go and buy out at these levels.
Okay, would stay away from the two-wheeler space. Senthil, is the rally over in two-wheeler stocks, or should one start accumulating?
So I think one should start looking at this space at this point of time, because if you look at all the three companies, they have good management, they are cash rich, and they are better ROE companies. If you look at what is going to happen is next 2 to 3 years is, like Avinash mentioned, Bajaj is going to focus on the M1 category, that is 100cc vehicle space, where the Hero's brand, that is HT down, is the leader, while Bajaj wants to make CT under the leader in this pack. And eventually they want to focus on the M3 category of between 125 to 150cc category also. So going next 2 to 3 years, what the market expectation is, there is going to be a margin deterioration across the sector, which I think the valuations are partially got impacted due to this margin impact. So I think except these three players, we have the other player, that is Eicher Motors. The Royal Enfield as a segment is also growing at around 20-25% growth. So going forward, what we see is that the growth in the premium segment is going to be much higher than
that. So are you looking at Eicher Motors as a play? What would your play be? If you had to pick one, if you had to put a pecking order, there are 4 listed companies. There's Bajaj, there's Hero, there's TVS, and there's Eicher. So among the 4 large listed companies, what's your pecking order and why?
Bajaj and Eicher could be my preferred picks among the 4.
Why do you prefer them over the other?
So if you look at the last 4-5 years, the growth in the premium segment has been much higher than the economy segment. So the market is going towards the premium and much higher, and people tend to uptrade in the when they are first starting with the economy segment. After initially 3-4 years of usage, they tend to uptrend to the mid-weight category or something like that. So if you look at this segment, Bajaj Auto and Eicher are the clear leaders in this segment. Bajaj with its brand Pulsar, and if it's recent tie-up with Trump, it is going to be a great growth potential for Bajaj going forward. While Royal Enfield, I think the growth which Royal Enfield put up in the last 3-4 years is tough to put up in the next 2 to 3 years, but the growth can be reasonable around 20-25% kind of growth with the international operations coming on stream. So these are my 2 preferred picks.
And what makes you stay away from TVS and Hero? What are the problems that they are facing?
So TVS, as we know, they are the lowest margin players in the sector. So now with more pressure and competition coming in, I think their margin expansion is going to be pretty tough. And with respect to Hero, if you look at they have been trying to enter this sports, and but they are not able to enter this segment even after 5-10 years of putting up new brands in this segment. They continue to be a economy player. So, but we expect the economy to grow lower than the premium segment.
So you're betting basically on the premium segment, that is Eicher Motors as well as Bajaj. Same question, Avinash. Among the top 4 auto 2-wheelers, what's your pecking order?
No, I think pecking order would be obviously Eicher Motors, as Senthil mentioned. I think the premium segment I don't think is going to be impacted by price cuts, and here the customer is willing to pay a premium. So this segment is definitely going to grow in double digits, and I think Bajaj Auto had an interesting point at the AGM. They mentioned that electric vehicles is now going to be the next growth driver. In fact, possibly in the next 12 months, a new electric vehicle, motorcycle and a 3-wheeler is going to be launched. So I think this is one interesting area which the management seems to be quite gung-ho and quite positive and seems to be aggressive on. So I would believe that, looking at the fact that now the quadricycle will be on the roads, clearly the 3-wheeler business is a cash cow. Most importantly, how they managed to actually carve out a market share from the economy segment is very interesting. Although it does give them, obviously a hit on their margins. I would prefer Eicher Motors, Bajaj Auto, and then say Hero MotoCorp.
And the problems for TVS, I think, continue. Do you think that they will be able to get back to double margin?
I think, Darshan, clearly it looks a tough call, because traditionally, if you see the margin picture for all the 3 players, TVS enjoyed the lowest EBITDA margins, and I think clearly this business is a game of volume. So I think TVS possibly would have to cut prices and obviously would have to take a hit on their margins. So I think TVS could possibly be the worst sufferer here.
And how does the BMW tie-up play off for TVS?
Actually, Darshan, we'd at least, I would not be knowing what is the kind of volume growth number which is going to come in, but I think clearly from a competitor perspective, this has not impacted, Royal Enfield's volumes at all. So I would not believe that, this is going to be a major threat or is going to be a major contributor to the EBITDA margin for TVS. So I think unless and until we see larger numbers coming in, on a monthly basis and on an annual basis, I don't think this business is going to make a significant material difference to the overall EBITDA margin.
Okay, so that's the view that's coming in. I think Eicher and Bajaj Auto seem to be ruling the roost as far as the 2-wheeler space is concerned. That's what our guests do indicate. And TVS doesn't find much preference given the fact that, it's been laggard as far as margins are concerned. Let's move on to the last and final stock. Since the markets, mid-caps have started rallying over the past few days and Nifty is almost coming back to new highs, we thought it's best to ask our guest which is one stock that they believe someone should hold for an investment purpose. So Avinash, I'll start with you. Which is the stock that you're talking about?
In fact, Darshan, we like a stock called Mahindra CI. Now, this is the company which actually is a Mahindra Group company and caters to almost 60% to the European market and almost 40% to the Indian markets. Now, they came out with very robust numbers for the second quarter of this calendar year, that is 2018, where the overall top line has grown by 29%, bottom line by about 25%, and the management is very strong. In fact, in the management management commentary, they were clearly very positive on the kind of expansion in markets, in the European markets as well as in the domestic markets. Clearly, they see a lot of operating leverage from the kind of fresh capacities they have created in Europe. And most importantly, margins are going to be retained. They expect that margins would at least be maintained, if not come down. And overall, our sense is that obviously, over the next, say, 2 years, if this company actually maintains this kind of growth rate, we could see possibly a EBITDA of more than 1100 to 1200 crores and a bottom line of roughly about 650 to 700 crores by FY20. So this is a long-term positional auto component play and available at reasonably good valuations. On FY20, we are looking at a price to earning multiple about 15 odd times, which looks pretty decent considering their size and scale and the group image.
Okay, just a few follow-up questions. How has the financial performance been over the past few years? At what rate have been growing, and and you said that they've looked to maintain their EBITDA margins. What are the triggers that probably will aid them in move their margins higher at a later stage?
No, I think they have acquired Italian company, and clearly they have a forging company called CIE Forging in Europe, which is yet operating at around 40 to 50% utilization. So I think here the lever would be on the capacity utilization, and most importantly, they are operating at EBITDA margins of almost 14 to 15%. The management is quite hopeful that EBITDA margins could obviously improve over the next 12 to 18 months by about 150 to 200 basis points. So clearly there is reasonable scope to believe that volume growth as well as margin improvement could actually kick in, and considering the fact that they've got a very well diversified customer base and more importantly not largely dependent on the commercial vehicle business in the domestic market, I think to a large extent they are not vulnerable to the kind of shocks which we saw in the CV market. So clearly they are more present on the passenger car and the on the SUV segment, and in Europe clearly there also not a single customer has got more than 10 to 12% single exposure. So the concentration risk is also not there.
Okay, it's 242 the stock price. Any kind of upside do you see? And what's the timeline, positional holding timeline that you're talking about?
We are talking about 18-month time frame. We are looking at a target price of around 330, 340.
Okay, 330, 340. Any risks that are associated that you would want to say?
See, I would be, unless there is a large currency risk which is associated with Europe. I mean, if something happens on the European side, and most importantly, if there is a kind of demand compression in that market, because 60% of the business comes from Europe, 40% from India. So I think, it certainly has a global risk attached.
Okay. That's the view that's coming in. Mahindra CI is the stock that Avinash speaks about, and Senthil, which one do you like?
So we like Axelia Kale.
Okay.
So the company is into providing IT solutions to the airline sector. So it's the only pure play IT company which is focused on the airlines. So if you look at the company, their product offerings majorly towards providing IT solutions on the passenger revenue accounting for these airlines. So basically the revenue is based on the based on tickets. So how much growth is coming from the tickets, the revenue will mimic the ticket growth. So if you look at the company ways, they have been the leaders in this segment, and if you look at last year, there has been a management change with Warburg Pincus coming in and acquiring a majority stake. And if you look at last year, Warburg Pincus, when they acquired the majority stake, they did an open offer at 1,220 rupees. And going for the product ways, their major product is Rivera, that is into revenue accounting. They also have 3-4 other products which are always catering into the cargoes and other segments of the travel industry itself. So now if you look at the long term, their sales growth has been in the range of 10% CAGR, and our PAT has been in the range of 25% CAGR. Now if you look at the valuations phase, I think it's trading at around 17 times FY18 earnings. And if you look at the dividend payout is around 80%. So considering a strong cash flow generation, and also with the rupee depreciation, it's always another tailwind for the company. I think it's comfortable on these valuations because dividend yield is around 5.2%.
So basically, if you look at the last few quarters, they haven't been performing well. At one time, they were moving. The stock price was very active. What's the reason that revenues and has been rather muted for them?
Yes, actually, if you look at their revenue, it tends to grow along with the overall global airline ticket growth. if you look at the long-term trend, it has been in the range of 4 to 5%. So this should be their natural revenue growth.
Okay.
If they add additional clients, then it will be like on top of this. So like you mentioned, if you look at the last 1.5 years, there has been a lot of news with Warburg Pincus coming in and open offer, and as such, the stock has been pretty re-rated. It used to trade at around 13-14 times. It got re-rated to 22 times trailing 12 months EPS. But now it has corrected a bit, and I think now the valuations are pretty much reasonable and in line with the company's fundamentals.
Okay, any risks that are associated with Auxilia Kale?
We don't see any such risks. Only one risk we factoring is about the forex fluctuations. Plus we have to watch out for how because Warburg Pincus is also a majority holder in another company called Mercator. So they are also in the same segment. So we have to watch out how the integration between the two companies happens.
Okay, and finally it's trading at 1050. Any kind of target that you see? How much, if someone is buying it, what time frame should he hold it, and what kind of potential returns can he expect? If things go according to plan, as you pointed out.
So it's remaining a portfolio pick. One has to take a 2 to 3 years view for this company, because we have to watch out how the management is going to integrate the Auxilia Kale, the Indian operations, with the Mercator, and how the products are going to come out in the future. So we don't have any target as such, but at these valuations, it remains attractive.
Okay, so that's the view that's coming in from Senthil. So it's Mahindra CIE that was recommended by Avinash, and Auxilia Kale, which has been recommended by Senthil. But with that, we are timed out on today's Hot Money. Avinash, thank you so much for joining me on the show. Senthil, same. Thank you so much for coming here today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.